7 years? Because it's very short term, it's guaranteed by the US government, so there's almost no risk, at least so far. Then we look at intermediate term bonds. Now, this is a different kind of a bond. It means in this case, it's a 5 year bond. Instead of loaning for 30 days, you loan for 5 years. And so you're taking more risk of having interest rates go up and down and causing the underlying value to go down and up. The point here is for the little additional risk that you take to go from the short term bond to the intermediate term bond, it goes from 3.3 to 4.8, and your $100 grows to 9,712. Now, the most volatile, and I think this is really important that you understand, three very different kinds of bonds. And there are many other kind of bonds. These are government bonds. We could do the same, have the same conversation about corporate bonds, high-grade corporate bonds, low-grade corporate bonds, international bonds. There's a lot you could know about bonds, but these three are the most common. And we're going to learn our lessons about risk and return from these three because you did get a premium. How do I find that there's more risk? Look at the worst year return for the short-term bond, about 0.02%. Very small negative year. And with intermediates, there was a year, and it just happened several years ago, that the intermediate term government bond went down 9.4%. Now, the bond is still going to mature and pay that original bond value, but in the meantime, it went down as interest rates went up. But long-term government bonds, where you're waiting for 20 to 30 years to get your pay, and now you're guaranteed to go through some periods of higher interest and lower interests. And what do we know? We know for taking that additional risk, you got 5.1% instead of 4.8. You ended up with about $12,000 instead of 9,700 or instead of 2,300. Risk and return. Take more risk, get higher return. Now, is it possible you could take low risk and lose everything? Well, where would you cash one of your Confederate bonds that a relative may have left you from a long time ago? There are bonds that, in fact, go out of business and have no value. That's certainly not uncommon in the junk bond market. Anyway, you got the idea. And I want you to notice this. This is really important. Notice the volatility of the best from the best year of the last 97 and the worst year of the last 97. The best year for short-term bonds was a gain of 14.7%, and the worst year was, as I mentioned before, a loss of 0.02%. On the other hand, the intermediate term bond, its best year was a gain of 29.1%, and its worst loss was 9.4%. The long-term bond, the best 1 year, was a gain of 40.4%, and the worst was a loss of 26.1%. And by the way, that loss of 26.1% did not happen in the Depression. It just happened a couple of years ago, and I will tell you, it was a shocker, and some people came to the conclusion that bonds are a terrible place to put your money. The stocks are better than bonds. Well, it turns out, by the way, that one bad year does not change the characteristic of the underlying asset class. And so what happened was the series of events were just such that during a period of time that interest rates quickly increased, the bonds, particularly the long-term bonds, quickly decreased. Now, again, they will come back and pay the value of the original loan at maturity. But you may have to wait around for a long time to get the money that you put in right before that big loss happened. So this is one asset class, bonds, showed at three different levels of risk: short-term, intermediate, long-term. I do want you to see, let's remember this best 1.14.7 and worst 2/100%, etc. And let's look at what happens to the best and worst years as we go to the next table, where we are looking at a 15-year period starting in 1928. There were 83 of them. Yes, some of them, of course, overlapped, but there were 83 starting with each calendar year, 15-year periods. And here's what we know: that the average compound rate of return was 3.6 for a year instead of 3.3. The best was 8.3, and the worst was a gain of 0.2. So we have narrowed the spread between the best and the worst. And when we look at the intermediate term government bond, it is 5.2, and the long-term government bond 5.6. Those were the average 15-year returns. And you can see again, let's just look at the long-term bond. Remember, the best was like 40%. Well, now it's 13.5. And the worst was a loss of 26%, and now it's a gain of 0.4. The longer you invest, the more normalized and the narrower that range of likely outcomes is, at least based on all of history to come. Now let's look at 40 years. 58 40-year periods. What do we see? The average 40-year compound rate of return is 4.4%. What is the average of intermediates? 5.9. What is the average of long-term, more risky? 5.9. So the reason I am not a fan of long-term bonds is because you have to take an appreciable additional risk in long-term bonds to, in the end, likely get the same return as the intermediate term bonds. But notice again, as we go out and look at longer and longer periods, the spread between the best and the worst declines, more predictable. So when we talk about what your 40-year return in bonds are likely to be, I can't tell you for the long-term bond whether it'll be closer to the 9.7 or the 2.3, but it will be more than likely within that range. The same with the range of intermediates, from about 8 to about 3. And with the short term, 1 month, 6 to 1.6. It gives us at least some way to predict what it is likely to be. And of course, that also assumes the U.S. government is still there paying their debts. But now we look at stocks. I mean, this is the reason we're here, and this is to really think about how much we want in stocks and how much we want in bonds. And we'll do a lot of work later in the series about people who are in retirement. But I will tell you, for people who are just getting started, and on May 29th, I have the honor of addressing, I hope, 200 to 300 seniors at Western Washington University. And I will tell you, I'll be beating them up about stocks. I'll be making the case that for that 401k money, I want you in at least the first 20 years to be putting your money into equities. And this is why. It's the same $100 that was invested in 1928. Now we have 4 different levels of risk, and it pertains to equities. I am not going to try to look at the return of equities one at a time. But what I am willing to do is to look at an index that, in essence, represents all of a particular equity asset class. But I do know there are big companies. Well, that would be this one right here, LCB, large cap, big companies, balanced. Balanced how? Between two kinds of equities. One is called growth. Those are the companies that we love to talk about. We like to brag about having invested in them because if we picked the right ones, we made a ton of money. Growth companies not only during certain times produce unbelievable returns, but when you look at what people are willing to pay for them, it is literally on average twice the price of what they would pay for a more conservative stock or company or equity asset class. And that price that people pay for the earnings, that's called the price to earnings ratio. So if you have a stock that earns $1 and its PE ratio is 30, it is selling for $30. The price is going to be so many times the earnings. 30 is a normal price to pay for the earnings of a growth company. A value company, another big company, it would typically sell for about 15 times earnings. And that's because people aren't as excited about it. I will tell you what has happened over the past is there are periods when people get really excited about growth, and then when growth has failed them, they get really excited about value and they want to be in something safer. And over a long period of time, it is interesting. The value is in some ways more volatile. Other ways it's not. But I'm going to say it's more risky. And it's more risky because the companies aren't as secure as the growth companies. Growth companies typically have lots of money to grow with. They have great management. These are big companies. These are trillion-dollar companies in some cases. But here's what I know about the past. I know that if I owned all of those, and typically we call that the S&P 500. Let us think of the S&P 500 as the 500 largest companies in the United States. Now, that is not exactly what it is, but it's close. And what do we know about the S&P 500 over the last 97 years? Its compound rate of return has been 10.2. Want to take more risk and put all your money only in big companies that are out of favor, value companies? The compound rate of return was 11. Now, remember when we talked about the $100 with the short-term bond fund, U.S. government guaranteed? The $100 grew at 3.3 and became worth $2,300. $2,300 versus $1,186,081. Now, do you see why we want young people to be in the stock market? Not because they have 97 years to have money grow. By the way, my wife and I gave our youngest granddaughter 2 years ago when she was born money to put aside to grow in her 401k when she qualifies. So that means that money that we gave her can literally grow for 100 years because people being born today are expected, according to the actuaries, to live to be 103. There'll be about a 50% chance you live to be 103. So a granddaughter could, in fact, realize this 10.2%. Or if you had made 8/10 of 1% more, and you had it in large cap